Hello traders. Today we are going to look in this video first 5-minute candle rejections, the open range trading secrets. They say the amateur open the market and the professionals close it. But the truth is the first 5 minutes provide the roadmap for the entire day. In this video, we are diving into the first 5-minute candle range strategy. We aren't just looking at a single bar, we are looking at the psychological footprint left by big institutional players as they battle for direction in the opening minutes. The characteristic of the open range. The opening range is defined by the high and low of the first 5-minute candle. This creates a value zone that acts as both a magnet and a barrier for the rest of the session. The high and close range, this represents the ceiling. If the price struggles to stay above the first candle close, sellers are defending the top. The open low range, this is the floor. If the price dips but fails to break the opening price or low, it signifies strong dip buying by institution. The failed breakdown signal, as in 3 point A, 3 point B and 3 point C, multiple attempts to break the open price that result in wicks or immediate reversals indicate that the trend is likely to shift in the opposite direction. Just look at this chart. The point 3A, it's getting rejected in the close of bearish candle. So the candle color also red, even though it's a bullish. The second 3 point B also it got rejected in the close price level. So the third 3 point C, it's ready to go reversal and it creates a momentum. So the close price rejection is indicating the price will not further go to down. So it's ready to go further to up. So this opportunity we can identify from the open range from the first 5 minutes candle. How to capture the long? It's been long opportunity using this open range. In this slide, in a long opportunity scenario, we look for demand validation. It means the scenario, the market opens, establishes a range and then tests the lower boundary of the first candle. The trigger, look for a candle to close back inside the range or a long tail. It's a wick. Rejecting. So it's rejecting the first candle low. When the price refuses to close below the first 5-minute open price after multiple attempts, it's a signal that the bears have exhausted their energy. This is your cue to enter with a stop loss just below the 5 minutes low. The bullish bias, if a price spends 80% of the first 20 minutes trading in the upper half of the 5 minutes candle. Bearish bias, if the price struggles to stay above the 5 minutes opening price and repeatedly wick reject the top. If the price stays exactly in the middle of the range, do not trade. Wait for a fake out at the high or low to capture the reversal. The long opportunity, price dips to 5 minutes low but fails to close below it. This is market action. Entry trigger, enter when a candle closes back above the 5 minutes open. So look opportunity here in the previous slide. Look for the 3 tap failure, 3A, 3B, 3C like that. If it is failed, To break down three times, the move up is usually explosive. Sometimes in this slide, the long opportunity, if the close price rejected and the green candle formed in the next above that close price, so this is a entry trigger for long opportunity. You can go for long entry. In this slide, we are looking for short opportunity. Look at that chart. In a short opportunity scenario, we identify supply dominance. The scenario, price pushes toward the first 5 minutes high but cannot sustain the momentum. Sometimes the middle or the price close also will get rejected. This is the perfect example. You can capture the trending day when price getting a multiple rejection near to price open or price close of the first candle range. A rejection at the first candle close price, if the price attempt to break out but quickly closes back below that initial 5 minutes ceiling, the breakout is considered fake. Watch for the V reversal of the high. If the second or third 5-minute candle fails to exceed the first candle's high and instead breaks the first candle low, a heavy sell-off is often imminent. So that day will entire day you can expect the trending day. It's towards in the bear market. So this is the indication you can find out from using first 5-minute range. You can also the pro tips. Let me explain how the failure to follow through. The best trade happen when breakdown or breakout fails. In my third chart, this is the price tried to break the open price three times and failed. This triple failure is high conviction signal of a massive move toward the first candle low. Also, you need to consider volume confirmation. Always look for the decreasing volume on the rejection and increasing volume when the price starts moving back towards the opposite side of the range. The 15-minute rule, you need to remember this one when you trade with the first candle range. If the price remains trapped within the first 5 minutes range for more than 30 minutes, the eventual breakout will be much more explosive due to the coiled spring effect. Early direction indication. By mastering the first 5-minute candle, you aren't guessing where the market goes. You are reacting to where the money is flowing. If the first candle open price holds as support, look for the high. If the close price holds as resistance, look for the low. Respect the range, wait for the rejection, and let the market show its hand. The 5 minutes range isn't a wall, it's a filter. We don't trade the breakout, we trade the rejection of the breakout. When the market tries to go one way and fails, the move in the opposite direction is the fastest money you will make all day. I hope you got some new knowledge and useful knowledge. Um, this is education purpose only. So do back test well, practice for, the paper money. Then you can go with the live trade after you multiple practice. One disclaimer: this is educational purpose only. You need to consult with your financial expert before you go any investment, make any trade. Thanks for watching.